jump into today because we got a ton of stuff to cover. And once again, like yesterday, I think we have a bunch of real positive news that's going to help mortgage lenders and real estate agents. We're going to be looking not only at rents, but rents relative to what's taking place with the housing market in terms of purchases. We're going to look at the likes of BlackRock and what people perceive to be their biggest problems. So, hey, listen, if you're meeting us for the first time, just make sure you subscribe. All you have to do is go to mortgageshots.com and hit the subscribe button. And of course, like and leave me comments, because any comments you leave, they're all read and they're all wildly, wildly appreciated. So let's jump into today's show and what we're going to talk about right now. Okay, so the motto for today is going to be failing up. So let's jump right into this whole idea of what's going on today, and I want to explain to you what I think about this. So apartment rent growth, if you're looking over on the right-hand side, Austin, Texas, the hottest market in the country. Right now, if you want to go there and get rent, your rent is $13.26. It's dropped by a full $300 here in just a few years. That's a massive numbers. That's groceries. This is an inflation buster when it comes to rents. Fort Myers, Florida, down 15%. Colorado Springs, Santa Maria, California. But do you notice the theme here? Texas, Florida, Colorado, California, Florida, Arizona, Florida. And we got a couple of outliers there. But what we are seeing here is a lot of the states that saw the biggest boom are seeing the biggest busts right now. Here's another example of the biggest peaks and changes that we've seen statistically when it comes to rents. Again, Florida, Texas, Florida, 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 Louisiana, Florida, Texas, Florida, Florida, Texas, Florida. Again, we're starting to see a theme here. The states that do great and go up fast, they go down just equally as fast. But what this is really, is I like to say, a canary in the coal mine for what the rest of the market is going to do. You're going to start to see rents drop all across the country. Now, yesterday I told you how Lennar has dropped 23 of their 25% gains since 2022. Boy, that's a mouthful. Since 2022, they've lost all their gains. They have dropped prices on new homes by nearly the 25% gains that they had over the previous 3 years. The numbers are remarkable, and we're going to see the previously owned single-family market follow suit, and we're going to start to see prices drop. And again, I told you, we're going to see a 20 to 25% drop in home values. And frankly, since this is happening so soon, I think it's going to be bigger. But here's the connection I want to make to you. With rents going down and rents now being way more affordable than buying houses, this is going to put pressure on new home builders and pre-existing homes to drop their values even further to stay competitive with rents. Because somebody who's a first-time home buyer is going to say, well, I can rent for X, or I can buy for X plus 200 or X plus 600. And a lot of those folks are going to say, screw it, I'm going to rent right now because I don't think we've seen the bottom. That's going to take the new home market and the pre-existing home market for sale, and it's going to make it drop even faster. So in your market, guys, I'm telling you right now, you're going to want to watch what takes place, because we know that rates are going to come down. Rates are coming down. But right now, the thing that always had to change, and I've been consistent with this, is values have to come down. And right now it's happening, and it's happening in a real big way. We're going to see a huge change in the housing market where we have more sales and more listings before the end of 2025. Moving on. This is my state of California. Tech jobs are leaving California. What I thought was pretty funny about this article is they said it's leaving California because of artificial intelligence, which I find kind of strange, because artificial intelligence is now being discarded or scuttled by a lot of the bigger corporations who simply aren't finding a value in it. They're finding a value in actual intelligence, not artificial intelligence. But what I find funny about this is assuming people are leaving California because of artificial intelligence or whatever reason you want to give. They're not going to Austin, because we just saw the Austin market, it's screwed. They're not going to North Carolina, we saw that market, it's kind of screwed right now. So where is everybody going? And the truth of the matter is they have artificial intelligence in North Carolina, Austin, Texas, Phoenix, and Seattle. When we get affordability back, what happens is we're going to see this market change. And what's taking place in California is just one of those examples. Now, this graph is pretty interesting here. It's long-term performance of the stock market versus housing. Frankly, this is the S&P versus the housing market. If values go up, and they always come down, what goes up comes down. What do we expect to take place over here with the S&P or with the housing market? I see this graph as a lot of people who've seen significant gains in their indexes that they've invested in. They're going to start to see the value of the housing market. Money's going to come out of the S&P, it's going to come out of the Dow Jones, and it's going to go into the housing market. So the S&P is going to come much more in line like it was in 2010. So, and again, this just spells another wonderful opportunity for housing. When property values go down, yeah, what's going to happen is people are going to say, okay, I am moving my money because I don't think the stock market is going to continue on this trajectory, and it's going to bring more people to the table. Okay, year over change in earnings. I find this one very peculiar. Look at how much people made during the COVID meltdown. That was during the Great American Giveaway when everybody got a check. All that big bump that you see there, that are all the 30% extra dollars that are right now circulating in economies all across the world that are devaluing the dollar and making everything and inflation more expensive. Side note, get some of those dollars off the street. The point here is we've seen an obvious correction since the Great American Giveaway, but highest earners have fared the best. That's not terribly shocking now, is it? Lower middle class, the second best. Upper middle class, the third. And the lowest earners, as is always the case in every market, get screwed the most. Okay, what Americans believe are the biggest cause of the housing costs in the United States right now. The number one is investors are buying up housing to turn a profit. 48%, nearly half of people believe that's the biggest problem that's hurting the housing market. I would say that's misguided, and I'm going to show it to you, and I'm going to explain to you what we do about it. The materials used to build homes are too expensive. We hear this about framing wood, we hear this about shingles, weather stripping, everything. The point here is this: most of that stuff comes from Canada. It's not hit by the tariffs, and the costs have come down. Landlords are raising rents faster than necessary. Not true. They're actually dropping rents right now all across the country. Number four, elected officials do not prioritize policies to make housing more affordable. They've been doing this for the past 50 years. Quite frankly, none of it's worked. Everything that we've done to help underserved communities has failed miserably, and we've spoke about this before. So our elected officials, they're trying something. They're spending trillions, not billions, but trillions of dollars through the GSEs and HUD, and none of it's working. The workers hired to build homes are too expensive. Maybe that's a little bit of, that's not a little bit. That's not going to change. Getting good skilled labor is difficult. People are converting their homes into Airbnbs instead of renting them. Airbnbs, that ship has sailed right now. People moving within the United States to where housing is expensive. Okay, 10%. It takes too long to build a house? No, it doesn't. But anyways, I want you to think about this. So I was thinking about investors here. The national average across the country, roughly 20% of the 86 million single-family homes are owned by investors. Is that number higher or lower than what you thought? It's right around where I thought. Maybe I would have thought it a little higher. All right, the next one, mom and pop investors. The vast majority of investor-owned residential properties, over 90%, are held by small investors with fewer than 10 homes. That's a big deal. That is a mom and pop investor. 90%. So when we look at the institutionalized investors, and trust me, I don't like these guys as much as you don't like these guys, but they don't represent a huge part or a swath of the housing market. Large institutional investors, 2%. Geographical variations. The share of investor-owned homes vary significantly by location. That is true. For example, some states with smaller populations and tourism economies like Hawaii, 40%, Alaska, 35%, and Vermont, 31% have higher percentage of investor-owned homes. Meanwhile, large populous states like California and Texas have lower. That does kind of make sense now, doesn't it? Investor activity in the housing market. Rising market share. In the first half of 2025, investors' share of total home purchases reached a 5-year high, hitting 27% in the first quarter and 33% in the second quarter. Still a pretty small number. Second one, weakened markets explains a share increase. Of course it does. Focus on lower price homes. Many investors have concentrated on purchasing lower cost properties with an average price of around $455,000 compared to a national average of $512,000. Okay, so as prices drop, we're going to see that number go down. And don't be afraid of smaller loan amounts. Okay, we all hate BlackRock. They're the big institutional investors that are buying up all the homes, making things too expensive. Their portfolio is doing pretty good right now. It's at $13.464 trillion. Yes, they own everything. They own everything. It's just not homes. Isn't that crazy? This is a really interesting one. Doesn't have anything to do with housing, but look at this. Oh my goodness. Why is gold doing so good right now? Gold is also, people investing in gold right now is also going to be hurting the stock market. People are going to be looking to move their money in other areas, including housing. Gold has gone through the roof right now because China is buying all of it. Absolutely all of it right now. What do you make of this? Honestly, I don't have a take. This is really one that I'm looking for you guys to give me an answer, because this one, I think there's a lot of meat on the bone. It's just out of my purview at this moment. Look at how much gold has been purchased by the Chinese literally in 2025. Absolutely through the roof. Why is that? I don't know. Remember, my friends, Unsuccessful people, they wear their failures. Successful people, they build on their failures. So just get yourself up, dust your knees off, fix your hair, do your shit, and pick up your phone and call some people. And do not be afraid to try something you haven't tried before. Fail up, my friends. Fail up. I hope this helped.